Trade war fears have rattled investors across the globe. For our viewers to understand what really has happened. First, US tariffs on Mexico and Canada, 25% tariffs go into effect from today. So that's something that has gone into effect from today. Canada has announced retaliatory tariffs, and they have also doubled. The US has also doubled their tariff percentage on China from 10% to 20%. As per initial reports coming in, China has said that, look, we reject this, we will implement countermeasures. So that really is the current tariff situation. Remember, we have heard US President Donald Trump also say that, look, 25% tariffs on steel and aluminum imports will be implemented for all. Reciprocal tariffs will come into effect, which also includes India as of now, from April 2nd. So we have seen all these factors as far as the tariff announcements have been concerned. Now we have seen Asian markets, US markets witness a massive sell-off, the biggest one-day loss in 2025, biggest single-day loss that they witnessed. Then we saw Asian markets rattling in trade and plunging in trade, with Japanese stocks plunging most. And we saw our markets witness the lowest ever open since June 2024. So India's benchmark indices, the Nifty and the Sensex, witnessing the lowest ever open since 2024, since June 2024. So a whole host of factors domestically as well being talked about, such as continued FII selling, weak corporate earnings, and of course geopolitical tensions that continue to weigh given the Russia-Ukraine war. So all these factors at play. We are of course going to decode this with Sanchita Mukherji, Senior Business Economist. Sanchita, very, very clearly, trade war fears now rattling investors across the globe.
Yes, absolutely. I think the announcement that US will actually proceed with the tariff war with Mexico and Canada was a big setback to the markets, because somewhere the markets would have thought that there would be an understanding. However, I would think that in India, we are still better placed, because it's very easy for India to identify tariff lines where duty cuts can happen, which will not affect domestic industry to a large extent. And I think India's trade minister and Minister for Industry, Piyush Goyal's visit to US is on the same line, so that we can come to an understanding and avoid and reduce reciprocal tariff to a very large extent.
Sanchita, now I want to ask you that, look, we have seen the biggest ever sell-off that US markets witnessed. We have seen Asian markets tumble over 2%. Our market's still volatile in early trade at the moment. So how insular can India be from what the rest of the world is facing at the moment?
Not very insulated at all. In fact, short-term volatility are going to persist. There is also an issue in terms of domestically, if you were to see, last year has been the mother of all bull runs. So in equity markets, the returns have been very, very upfronted, with an understanding that GDP will be catching up to an 8% figure. Right now, there's an understanding of the market, which the market is trying to deal with, is that GDP growth has resettled from an 8 to a 6% kind of a range. Markets are very forward-looking, right? So the rally, which was there last year, increased the valuations to a very large extent, especially in the mid and small cap segment. Now, if the earnings numbers are not to match up with the subsequent GDP growth as well, and we are seeing that the corporate earnings are very subdued, that is why the price correction, especially in the segments which have run up tremendously, has happened. But having said that, domestic fundamentals are very, very strong. If you see all the macroeconomic indicators, the leading indicators, they're strong. So once I think the valuations are more comfortable for FIIs, they would reinvest back in.
Right, Sanchita, I'm also going to ask you that, look, for all those investors losing money who have lost significant money in the past few weeks, past few months, what sectors should they be looking at, and what should they be expecting then going forward from the markets?
That's a good question, Sakshi. So no investment advice over here. But having said that, I think as a market observer, the nature of the asset class is very lumpy. So in equities, one has to have a very, very long horizon of at least 5 to 7 years, because it takes around 5 to 7 years for an economic cycle and a business cycle to play out. You'd have years in which you'll get very, very high growth in terms of the equity market returns, and there'll be 2 years of very high digit returns, and then there'll be a lull for a year. Then there might be a year when you get a negative returns. So the idea is to look out for a 5 to 7 years horizon and be in growth sectors where the valuations are comfortable. If you're looking at valuations, if you're with a registered investment advisor and you understand valuations, it is important to invest in sectors which are defensive at this point in time, where valuations are decent and where the rally has not been at a very expensive cost in terms of growth.
Thank you so much for sharing your thoughts and, of course, decoding what's happening in the markets for us.